Welcome back to The Sweet Life. If you read articles around stock and crypto market news, you may have come across the article that 90% of investors lose money. And that's actually 100% true. Most investors ignore the warning signs of losing money and they assume that they fall within the 10% that actually make money. Well, in this video, let's talk about how we can actually become part of the 10% that make money and not just assume we're part of the 10%, because you know what assuming does, right? Recently, we're dealing with the Russia-Ukraine situation. We also have historically high inflation. What does that do? That puts downward pressure on the market, a little bit of fear in the market, and things like that. And when there's fear in the market, investors panic sell, and some even take a loss on their investment. Now, this leads me to a question for you. Have you ever panic sold in your investments? If so, why and how much did you lose? Comment down below and let's have a chat. But even though we panic sell, if history repeats itself, we'll not only recover our losses in the stock and crypto market, but we'll increase our earnings, show a little bit of green, and feel pretty darn wealthy. So let's look at the facts on why this is made up the way it is. And then what we're gonna do, stick with me, because at the end we're gonna talk through the tips that you must know so you can become part of the 10% that make money and not part of the 90%. Now I'm gonna start with stocks. This is super interesting. We're gonna say this is the year column. Right here, this is gonna be the pullback, which basically means this is how much is lost within the year that we're talking about. And then over here, we're gonna talk about the return from the bottom. That's a year later, looking at the bottom of the particular year and how well it recovered that next year. So let's go far, far back in time. I think a lot of us may not have been alive, but if you were, hats off to you and thank you for watching the video. 1962. So here I have 1962. That pullback that year was a total of 26%. So if you would have sold in 1962, you would have lost 26%. What a terrible, terrible situation. But a year later, look at where it comes back to. 32.7% return positive in that next year. Now, if you would have dollar cost averaged, which means you would have kept buying into your investments through that year as it was going all the way down to that 26% loss, you would have had a lot more momentum as it continued back up to that 32%. Now, I have a lot of videos on this channel that explain dollar cost averaging and the benefit of so-called buying the dip during this period of time. You can check out those videos after we're done with this one. Let's jump ahead to 1974. Now, 1974 was quite an interesting year because that is quite a dip at 37.6% minus 37.6% pullback. But look at the return a year later at 34.6%. So it didn't quite return exactly its pullback, but in the next years ahead, it certainly went onward and upward quite a bit. Now I'm gonna go far, far ahead to 2002. Now that was right after 9/11, so things were kind of shaky, but the overall downturn was negative 33.8% on the pullback, but then that next year, it came back to 33.7%. Now think about this for a second. If you would have sold at that pullback, at that lowest of the low, at 33% down, man, that would have hurt, especially knowing that it would have recovered only 0.1% down from what it was when this whole thing started. So that means you're giving up money when you sell. You're losing all that money. You don't get to gain it back, where everybody that held on through the storm, feeling pretty good afterwards. And then from there, it's only up. And that's a good thing. Most recently, we have 2018. Now, 2018 was also a very interesting year. We had a lot of volatility going on in the market, but it did drop 19.8%. But then that next year, look at this incredible surge at 37.1%. Now that's really good. So if you were a 2018 seller at the 19.8%, you're giving up money the next year at a 30% recovery. That's incredible. And that brings us to right now. 2022. The same type of thing is happening, right? So we have 2022, we're down about 13%. Now this source comes from LPL Research, and this is as of March 8th. But 13% down, we don't know yet what that return is gonna look like. Could it be 30%? Could it be less? But if you look at this, don't you see kind of a little bit of an example of 30% plus over these hard-turned years, 62, 74, 02, and 2018? That right there gets me kind of excited. And it makes me think, maybe I should consider investing if I have my foundation set up, which we'll talk about in just a moment. So midterm years, the corrections are very, very usual. It's gonna happen. It's gonna look kind of funny. It's gonna look a little depressing, and your portfolio could be red, especially if you're new to the market. But hang on tight and enjoy the ride. because right around the corner could be something good. Let's hop over to crypto, where there's a very similar situation. Now, I will say cryptocurrency does have a lot more volatility to it, so these swings can be even more stomach-wrenching. Think about it, it's a difference between, do I want to ride this very scary roller coaster or hop on the kiddie ride? The very scary coaster is going to give me some thrills, more so than the kiddie ride, but it's going to feel kind of funny as we're going down. So that's kind of what's going on here. Look at this, 2010. We have 24 days in a bear market at a 94% decline. You put your money in, you're basically losing it all, right? But then look what happens after that. 1,600% up, percentage gains after that downturn. Then we move on to 2017, right? So in 2017, we have 14 days, followed then by 35 days of a decline of 33% and 39%. But then look at the years after, 65% up and 49% up. The same deal is going on. You have a lot of decline, much more than the stock market, of course, but the gains after are like even better. Look at the overall summary. You have an average of about 89 days that the crypto market goes into a bear mode, which means it's going down, it's in a decline. 89 days at a 57% decline on average, which means that the gains after averaging 362%. So those people that are selling on a downturn are the ones that are really losing out, where everybody that just holds on and forgets about their money ends up seeing a little bit of positivity. I think it's important to look at the history and look at a lot of data. Going all the way back to 1962 is pretty cool in the stock market, and going back to 2010, that's what we have so far in the crypto market. Those things are good to know, because if we look at the game book, we can be a little bit smarter with how we invest. But that brings us to, how do we ensure that we're doing the right thing and not becoming those 90% of people, those fools out there that are losing their money? We don't want that, right? We want to be wealthy. We want to live our ultimate sweet life, and here are a few tips that you need to know. Number one, never invest based on a tip. So, here I am as a YouTuber giving you tips. Ugh. But no, seriously, if you're going to the media or you're going to a YouTuber and you're just hearing this, hey, this stock is about to explode, this crypto is about to explode, and all of a sudden you're looking around and the media is talking about it. That is warning flag number one, because when the media gets a hold of something and there's a lot of hype around whatever they're talking about, oftentimes it's at the top of a peak before it's going to experience a pullback. It's natural and it happens all the time. So a lot of the people that jump in when the media is hyping it are the ones that tend to get the most frustrated and the most losses when it comes down to their investments. Doesn't matter if it's stocks or crypto, to be honest with you. And a lot of people just recently experienced this with the Shiba Inu token back in October. There was a surge of Shiba Inu, went up significantly to an all-time high. Everybody was buying into this, and then all of a sudden, down it goes. Whereas the people that were researching it before made the most money, and the people that bought it after are right now either flat or slightly positive. Behavioral finance actually causes this, the recency bias, because people only buy when it looks like a lot of people are making money. And unfortunately, the factory settings in our brain are programmed in that way, where we're social animals, right? We like hearing and seeing success of others and duplicating that. But the problem with that factory setting in our brains is it doesn't work well in the stock market, where you're jumping in at the last minute when everybody's hyped it all up, and then you're at the top of the roller coaster, which means you get to enjoy the ride all the way down. See what I'm saying? So the point of what I'm trying to make is you've got to be careful about the hype. Back up a second and say, wait a minute, is this too overhyped? Do I need to take a look at this and see what it's gonna look like for the long term? Or if I do buy in now, am I okay holding for the long term? Knowing that there's gonna be a pullback, I'm gonna chill and I'm in it for the long game. Number two is a lot of people like to make money quick. Honestly, you could probably make more money risking it all on a casino than trying to use the stock or crypto market as your way to get rich quick. Honestly, this is not the place to be, because there's a lot of volatility and there's just a lot of short-term problems in both of these markets. And I've seen it time and time again. I like to look at building a foundation that you're gonna set your future on. Think about a house. You set a beautiful foundation so the house is strong and it stays up for a long, long time. Same thing with your wealth building journey. Got to get that foundation going, and putting all the money in and hoping that it's going to double overnight, that's not enough time for the foundation to settle so you can have a good wealth building house in the future. Get what I'm saying? The most important thing you need to focus on when it comes down to doing this is saying, I'm going to put this money in, know that it's going to go like this. It's going to happen. That's gonna be the chart that we're gonna see for a long period of time. There's gonna be days you wake up and it's in the green, and then there's days that you wake up and it's in the red. You gotta be okay with that. There's actually studies out there that say the amateurs that go in and try to day trade to try to make money in the stock market and crypto market, while some people do, and those are those cases that kind of get out there in the media and then make everybody think, oh, this is easy, I'm gonna do it too. But 90%, don't forget that number, tend to lose money in the market. And number 3 is investing money you just can't let go of. And that actually ties into number 2 because you have the gambling situation, and what you're trying to do is say, hey, instead of paying next month's rent, I'm going to risk it in the stock market. Hope it 10x's by the end of the month. I'll take my profits, pay off my rent for the month, pay my rent for the month, and then have some extra cash. But then the opposite happens. You put your money in, and that's right before something stupid happens in the market, down it goes, and then you absolutely freak out and sell for a loss. If you're investing money that you can't afford to lose, you shouldn't be investing in the first place. I always look at, can I pay off my debt first? In fact, you actually tend to get a better return on paying off your high interest credit card debt before you actually start investing. If the stock market and the crypto market is only growing at about 10 to 15%, you're actually, if you're holding a credit card that has a 14 or 20% interest rate on it, it's better to pay the credit card. You're gonna get more of a return if you pay off the balance and then don't have to deal with that high interest tacking on to your credit card bill month after month. And then if you have no debt, especially if you're able to pay off your cars and pay off your home, oh, you're in a serious position. You're in, I think, where I need to give you a salute and say you are a freaking rock star, because if you were at that point, you really have limited to no risk at all. You have no debt at all, which means you can go on speculative investments. You can go in and invest in the meme cryptocurrency. You can go in and start stockpiling away in the stock market. And the best part is you can just put money in there and forget all about it, because of your hard work in the past will now pay you off in the future. But think about it this way. There's gonna be times that you're gonna have bear markets, and bear markets means that the market is declining. It's pulling back, it's looking ugly, it's looking red. That's why we call it a bear market. Although I don't know why bears are associated with ugly and red. I think bears can be cute, but regardless, that's what it's called. Then the flip side of that is called a bull market. Bull is when it's going up, up, up. This is when everybody's excited, your portfolio is green, you're making tons of money, and it's feeling really great. But remember this, if you can't hang out with the bears and invest with the bears, you'll never be able to enjoy that ride up with the bulls. Think about it. Next video right here, subscribe for more, and we'll see you on the next video.